Welcome to the Keiser Report. I'm Max Keiser. The bond apocalypse is upon us. A new world order of ever-rising interest rates will make leverage, speculation, and decadence a thing of the past. Is your retirement plan to flip your house to some greater fool? Forget about it. Want to lock up your neighbor for the rest of his natural life because he dared do something in private to which you object? Forget about it. Have the sudden urge to send the troops to invade some oil-rich nation you've never heard about until yesterday? Forget about it. In fact, just about the past 30 years of dumb luck and declining interest rates in which even a monkey can make a thing, killing by borrowing and speculating, it's all over. You can just forget about it. Stacey Herbert.
Max, yes. Well, it just got a little bit more expensive to be stupid. Unprecedented $80 billion pulled from bond funds, a record amount of money poured out of exchange-traded and mutual bond funds in June, according to a fresh report by TrimTabs, nearly double the amount pulled out of bond funds at the height of the financial crisis in October 2008.
Yeah, bond rates are going up. It's a secular move. You had 30 years of rates going down. Now they're moving up. So people are dumping their bonds. Where are they putting that money? Well, we saw a rise in oil, even though there's been a commodity sell-off. So that money's going to end up somewhere, but it's coming out of bonds.
It's actually worth turning to this chart right here that I stole from Carl Denninger's site, and I felt free to steal it because I know you're interviewing him in the second half. And this is the 10-year Treasury yields, constant maturity. And you can see from 1980, basically yields have been declining for the past 30 years. So most people will only have knowledge of declining rates, whether they're an investor or just living in the world where they could always borrow more money and always juggle the debt, roll over the debt constantly at an ever-declining rate, so you could always make whatever stupid misallocation of capital you wanted.
Yeah, juggling debt. You're trying to eat while you're juggling. Let me demonstrate here. So you've got some apples you can juggle, and so the idea is, can you juggle and eat the apple while you're juggling? Not all that successful, but I think you get the idea.
Oh boy. Well, so TrimTabs also says that this has basically wiped out 73% of the $109.6 billion that flowed into bond funds in the first few months of the year. So remember, as we hit the peak bond, we also saw a massive flood in from the average investor.
Right, the average investor finally got up enough courage to roll into the bond market at the absolute top. And remember also, it's not just the individual investors, but governments around the world through quantitative easing are invested in the bond market. And as rates rise, that means that the bonds in the portfolio of the Federal Reserve Bank and corporations and other banks are going to become less and less valuable.
Well, as TrimTab says of this outflow of bonds, and this $80 billion, remember, just in June, they said, quote, until last month, investors had been content to shovel huge sums into bonds with little regard for value, confident that endless central bank liquidity would keep prices at ridiculous levels. It was only a few weeks ago that junk bond yields dipped below 5% for the first time.
Well, think of it also, you know, the Basel Accord, they're trying to get banks to increase their reserves. Of course, how do you classify a reserve? What is the collateral on a bank's balance sheet? A lot of times it's bonds. And these bonds are artificially high by quantitative easing and cheap interest rates. Now the interest is going higher, bonds are going to reduce in value. So this Basel Accord to try to increase the reserve capital of banks is a sham. It's never going to happen because they're now sailing into the teeth of rising interest rates. Collateral in banks is now going to go down sharply, which means another major bank failure is on the way. Is it BNP in France like I'm hearing, or Societe Generale? Could be.
Well, the other problem, of course, is that quarterly statements are about to go out. So TrimTabs does warn the rush out of bonds could be about to get even worse, according to TrimTabs, which says that more bond investors could take flight after receiving their quarterly statements in the coming months, noticing that their, quote, safe bond funds are delivering losses instead of gains.
Well, this is the experience of everyone who watches this show. They love what we talk about, but they only really look at one thing, and that's their monthly or quarterly statement from their bank or brokerage. And as long as that number is something they're happy with, then all is good. But once they open the mail and they see, oh my God, my bond funds collapsed this month, then they panic. Then they watched our show more because they realized they should have been listening to us more.
Well, as I said, it was easy to look brilliant for the past 30 years in bonds if you were in at the right time. Anybody could look brilliant. Any monkey could do it. So one of the biggest bond funds in the world, celebrated investor, is of course Bill Gross and PIMCO, and they're of course meeting huge redemptions in their funds. As bond market tumbles, PIMCO seeks to reassure investors. For 30 years, Bill Gross has been seen as a genius, but now $9.9 billion was withdrawn from his PIMCO Total Returns Fund in June. That's 8.5% of all the holdings.
Well, he's not going to outperform the bond market in the face of a bond apocalypse. That's just the way it goes for Bill Gross. I mean, he's got a bond fund. So unless he goes 100% cash or moves into something else, he's going to suffer the ravages of the reversal in interest rates that we're seeing now on a secular basis that'll continue now for 10 years or more.
Well, it appears from Morningstar data that he himself also was smoking his own belly button. He believed that he can't do wrong. For 30 years, he's been right. And 90% of PIMCO's assets were in bond funds. So the analysts in this article are pretty surprised that he's all in, essentially, on one asset.
Well, he's front-running the Fed, and that's been a strategy that's worked. In other words, the Fed tells Bill Gross, by the way, we're going to be buying lots of bonds. So he buys bonds before the Fed does, and he makes money front-running the Fed. But he's in a position now where his fund is so big, it's like trying to maneuver an oil tanker. It can't be done quickly and with an agility. You know, once he puts on the brakes, it takes miles and miles and miles for that thing to come to a full stop. So he can have a difference of opinion on where bonds are going, but to extricate himself from multi-hundred billions and $1 trillion worth of bonds is not something you can do overnight. So he's trapped, like so many other people, in the Roach Motel called the Federal Reserve Bank.
And the other interesting thing is that he has this total return fund, but he also has an ETF which tracks it. He has several ETFs. PIMCO has several ETFs tracking their other bond funds. And you see that actually those investors, those so-called investors, have much weaker hands. They're much more frightened off by any movements because 3/4 of the company's popular exchange-traded funds have experienced outflows during June, with 2 of them losing nearly 40% of their holdings, according to data from Lipper.
Yeah, well, they're flipping out of the bond funds. But he writes nice letters, though. Thing about Bill Gross, he writes very entertaining monthly and quarterly letters. He's a frustrated novelist when it comes right down to it. He's not much of a bond fund manager in this environment.
Well, I'll tell you what, his latest newsletter is called Tipping Point, and he ends along this line. These are his words. These are Bill Gross's words about whether or not you should flee his fund. Yell, "This ship's going to make it to port. Fed, PIMCO, and PIMCO co-captains willing," Mr. Gross wrote, adding, "Have a cocktail. Tell the band to stop playing dirges because you're going to be just fine with PIMCO at the helm."
And the band played on. Toot, toot. Yeah, grab yourself a lifeboat and get out of that sinking ship.
Well, of course, he's writing that now. On June 4th, he sent out a tweet, and he wrote then, "Keep smiling. 30 years of bond bull markets have raised returns and spirits. Now there are doubts. We're sticking with bonds as long as the Fed does."
What's wrong with this guy? He seems, well, you know, he wrote 6 months ago, in a moment of clarity, he was buying gold.
Yes.
And now I think he wishes, you know, inside every bond bull, there's a gold bug striving to get out. Bill and PIMCO, if he were really on top of things, he would immediately liquidate everything and move into 100% gold.
Well, he also did back in April. Remember, he did say that was the end of the bond bull market. So suddenly he's changed his tune. I guess he's the one playing on the Titanic, and he's trying to make everybody feel better. But
well, everyone's been trying to call the turn in the bond market for the last 5 years. The only guy who actually called it to within a day, I believe, is Michael Pinto, who, we've never had him on the show, but I think he's the actual guy who actually called it to within a week of the bond market peaking.
Now, Max, correlation doesn't necessarily equal causation, but I'm going to attempt to make it anyway with this chart, and that is the prison population in America. As you see, at 1980-81, that's when the prison population began to soar, and it's gone straight up. and a stupid policy of incarcerating people for ever longer periods of time, decades and decades, in some cases life without option of parole for minor, you would think, minor felonies. And I thought that was also another way that it's a sort of decadence that was enabled through ever declining interest rates, where people could just spend $44,000 per federal prisoner to lock people up for smoking dope.
No, Ben Bernanke is the new Pinochet. Remember the Milton Friedman's experiment with neoliberalization in Chile, and they expanded the prison population exponentially. Of course, Ben Bernanke's had the same, and the Fed heads going back this past 30 years of the bond bull market have had the luxury of ever cheaper interest rates to fund their prison industrial gulag complex known as America. You know, when they now report numbers that say, oh, we've got more people working in America, they just mean that more people are now incarcerated in their prison industrial casino complex, stamping out license plates and playing video games to aggregate virtual gold to be sold on some Chinese black market.
Well, you know, the final thing about this prison story, however, is just showing how stupid it is and how for 30 years we've been allowed to build up debts and decadence because it's been so cheap, and we keep on rolling over this debt.
So you're saying correlation is not causation. So you're saying that, look, these two charts match
perfectly.
They match, but you're saying it's not. Is it which came first, chicken or the egg, or is it the black swan, or is it a phenomenon that we don't have any rational explanation for? But you're saying that perhaps cheaper interest rates cause the increase in the prison population. Well, you know, humans are in effect like a bond. They keep producing an income in their work. And if you can finance more prisons and getting more people in prison doing slave labor at cheaper and cheaper rates, then of course you would end up with a prison industrial complex driven by lower interest rates engineered by central bankers who are in cahoots with corrupt politicians, of course. All right, Stacey Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Stay tuned for the second half, a whole lot more. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Carl Denninger of market-ticker.org. Carl Denninger, welcome back to the Keiser Report.
Thank you for having me on, Max.
All right. The bond market. What is going on, Carl Denninger?
Well, it's really rather simple. We've had a 30-year generally downward trend in interest rates. If you look at the constant maturity 10-year note yield, you'll see that the chart goes from the upper left to the lower right. It's been doing that since about 1980. And this is now changing to one of two scenarios because you can't go below zero. So you're either going to have a flat bond market, much like what Japan has had for the last couple of decades, or it's going to reverse and start trending back upwards. And this is very important because in a declining yield environment, you can print money by increasing your leverage. Every time you turn the crank, you not only make more money for yourself, but you put more liquidity into the system for everybody else, and so everyone else makes money. And so your options, if you hold your leverage constant or you don't have any, is that you make money because your assets go up in price, because the leverage cost of them decreases. And if you do turn the crank, you not only help yourself, you help everybody else at the same time. Well, in a rising yield environment, the exact opposite is true. If you don't turn the crank, you lose money. If you do turn the crank, not only do you lose money, but you make everybody else lose money at the same time. So this is the shift in paradigm that is happening. It's not a short-term thing. It's not something that's going to instantaneously reverse and result in everything collapsing and exploding all at once. But this is a secular shift, and there is nobody in the investment and business world younger than 50 that has ever lived in an environment as an adult where this, the world that we've been in for the last 30 years is not the case.
Right. Now, Carl, let's look at this in political terms for a second, because over that period of time, the past 25 or 30 years, federal deficits have increased, governments have gotten increasingly more in debt, and the way they've been able to do this is by riding this bond bull market. They simply extend the maturity, and they simply add on more debt, and they get bailed out essentially by the market because the interest rates have gone down over this period of time. So what happens to all this government debt if the trend has changed and interest rates start ticking up? What happens then, Carl?
Well, they're in a lot of trouble because in a flat to rising environment, having any leverage on it all is death. The only way that you avoid this is not to be levered. Of course, it's rather difficult to turn yourself from being levered into unlevered when you have taken on, in the case of the United States, $15 trillion worth of debt. And so how do you get out of that hole? And the answer is you have to reduce your spending by dramatic amounts because you have to be able to cover the ever-increasing coupon cost.
All right, Carl, during the Clinton administration, there was a species of money manager called the bond vigilante. Bill Clinton made a remark. He said, I wanted to come back as a bond trader because they have all the power. And so in other words, the bond market was sold off because Clinton's program and healthcare programs were considered to be too expensive, and there was some pressure. What happened? Whatever happened to the bond vigilantes? Where did they go?
You know, Max, it's rather amusing when you talk about that. And then there was a bunch of chatter the other day from a couple of bank analysts that were talking about how we had generally rising interest rates in the early 2000s into the mid 2000s, and yet house prices continue to go up. And I look at that chart and I say, yeah, okay, there were short-term moves that were counter-trend. Same thing during Clinton's term. But look at what happened with just those little short-term moves. The one from 2004-ish until 2007 is what blew up AIG and Lehman Brothers. But, and then you look at the other ones that have been associated with long-term capital, with the Asian debt crisis. But the secular trend remained intact on a downward basis. So, Clinton was right, but Clinton was looking at this from a micro level as opposed to a macro level. You have to pull a lens back and look at the 30-year trend and say, well, if it shifts the other way, then there will be short-term periods where increasing leverage will work. But in general, you can't have any on at all. Because if you do, you're going to continually get hurt as asset prices decline. So what you see is the gap between price and value in assets narrow, and assets become valued on their utility as opposed to being valued on their speculative premium. And that is a collapse that is going to hit all areas of the economy. Housing, people think of it as, well, this is how we get wealthy as average Americans. We buy a house, it goes up in value. No. Housing is a depreciating capital asset. You buy a house because you need a place to sleep.
Yeah, let's talk about the secular trends for a second to put this into context, because you're talking about a 30-year trend, and if you go back 30 years, what happened? Well, you had Ronald Reagan was in office, and you had Paul Volcker as Fed chairman, and to rectify the excesses in the economy that came through the stagflation of the 70s when the oil embargo was in place, prices were skyrocketing, but the economy was shrinking. Volcker raised rates, and I believe the short-term rates got up to 14 or 15%. A lot of people don't remember that. And then inflation was wiped out, I believe was the phrase at the time, under one of the presidents. And then you had this long secular downtrend in rates with the occasional bump. And of course, in 1994 was another bond sell-off with a rise in rates along the way. But what you're saying, Carl Denninger, is that on a secular basis, we've gone from a 30-year bull market in bonds now entering into a protracted, at least 10 to 15-year period of rising interest rates. Is that a fair characterization?
Yeah, there's only two possibilities, Max. You can either have a bond market that flattens out and essentially doesn't move at all in terms of yield over the next couple of decades, or you can have one that rises in rates. If you want to see what happens to asset prices when you have a flat bond market, look at Japan. 20 years, they've been trying to stimulate their economy and play their money printing games, and the Nikkei is trading at a quarter of where it was at the peak. So where's the success? I certainly don't see it. And yet this is, people say, well, we could have a 2-year treasury on the, a 10-year treasury yield in the 2% range for the next, 10 or 20 years. Well, sure you could. But then what's going to happen to stock market prices? They're going to collapse by 75%.
Okay, so here in the UK, it's a very similar situation. Interest rates are starting to tick up. And here in the UK, they've already imposed austerity, even though there hasn't really been significant cutback in public spending. They call it austerity. In America, they've gone down the path of stimulating by doing more money printing, et cetera, but that hasn't stopped the yields from ticking higher. And of course, in Japan, they were able to do this for 20 years because they were eating into their savings account, which they had accumulated after World War II, a massive savings account, but now that's been wiped out. So let me ask you this. If the US, the UK, and Japan all seem to be facing a similar situation, a secular shift in interest rates moving higher means that they're going to find it extremely difficult to finance that government debt as it rolls over going forward. So you're saying that these governments are going to have to, they have only one choice, right? They just have to stop spending. So austerity becomes just basically stop spending, right, Carl?
Well, it's not austerity. You know, people talk about that like being austere is some bad thing. Spending no more than you take in is a good thing, not a bad thing. And but Americans and people around the world in the Western economies, they're not used to this. The idea is that you can have anything you want. You want a new Cadillac? Go buy one. You want a new flat screen TV? Go buy one. Oh, you don't have any money? That's okay. We'll just finance it out over the next 10, 20, 30 years. People do the same thing with college educations. They do the same thing with houses. It's nonsense. We have to look at this as, everyone's tried to play Wimpy, the old Popeye cartoon thing. I'll pay you next Tuesday for a hamburger today. Well, guess what? It's Tuesday.
Yeah, of course. Who can forget Wimpy, the classic character from the early Popeye cartoons? Now, Carl Denninger, let's talk about timing for a second, because this idea that there's a secular shift in bond markets and interest rates are going to start rising has been talked about now for several years. So the question I have, and a lot of people would have, is, well, what stops the central banks now from coming in and launching a massive global quantitative easing-like program to stop this reversal from happening? Or are we saying, or are you saying, that basically all the bullets and the guns of the central banks have been fired and there is no recourse at this time? Your thoughts?
Well, how do you stop it from happening, Max? If you flatten out the yield curve and prevent the reversion by continuing to QE at ever greater amounts, number one, the amount that's necessary in order to continue to keep that from happening goes up exponentially. This is what we've seen. This is why, despite what the Fed has done, yields have not continued to fall. Secondly, there's a zero boundary problem. What are you going to do when you get to that point? You're going to try to drive negative rates? Well, for how long is that going to work? Mario Draghi seems to think he can get away with this. But even if he does for a short period of time, what does it buy him? Another couple of years? And then what? We're right back where we started, but with more economic damage, it's been compounded into the system. This is a fool's game. These people need to wake up and listen to not only what the Bank of International Settlements has said, which is basically, guys, time's up, the clock has rung. But in addition, they need to listen to the conversation that has been repeatedly had during Humphrey Hawkins' testimony with Ben Bernanke and the U.S. Congress, where Ben has said, look, there are limits to what I can do. Congress has to do its job. And what Congress has repeatedly told him is, we're dysfunctional. We can't do it. You have to. Well, guess what? When there's a child in the room that's eating all the candy, eventually he has to stop eating the candy because either he dies from getting no nutrition and eating only candy, or the candy runs out. Those are the two choices.
All right. Now, Ben Bernanke, you mentioned, of course, now he is talking about tapering, which would be he's going to stop, ease off on the quantitative easing. The markets immediately react. We had an immediate rise in yields. Bond markets sold off. He's talking about the rise in jobs in the housing market as a reason, or the signs that he's looking at, saying that there's a recovery. There's a recovery, and the reason rates are going up is because the economy is recovering, Carl Denninger. Is that true?
Employment participation ratio, Max. That's all that matters to the long-term sustainability of any so-called recovery. That hours worked, average hourly earnings, X credit expansion. It's a chart that I've put up on a repeated basis. The reality of the situation is that from 1980 to 2009, there was not one 3-month period where the economy expanded by more than the amount of credit in the system expanded. We had a couple of quarters where it happened during the depths of the crash. Now we're back to the same game, and quantitative easing is the tonic because the private economy is too levered and unable to take on any more. And the BIS has come out and said, you guys squandered the 5 years that central banks gave you to take this leverage down. Sorry, time's up. you run into the zero boundary. Now take your medicine.
Finally, Carl Denninger, I see PIMCO, over the largest bond fund in the world, suffered a pretty sizable multi-billion-dollar drawdown in funds last month because interest rates are moving higher. We only have about 10 seconds left, but would you, are you a bond bear? I guess you would, if you're selling out of bonds, where are you going? Cash?
Yeah, because in an era of declining asset prices, I want to hold hard capital. I want to buy things from people when they're over levered and blow up and have to sell them to me cheap.
All right, fair enough. All right, Carl Denninger, thanks so much for being on the Keiser Report.
Thank you.
All right, and that's all the time we have for this episode of Keiser Report with me, Max Keiser, and Stacy Herbert. I'd like to thank our guest, Carl Denninger of market-ticker.org. If you'd like to get in touch, tweet us at Keiser Report. Until next time, Max Keiser saying bye, y'all.